The wonderful topic of journaling. Some of you watching this at the moment don't do it because you think you're above it or you're too lazy to do it. And some of you do it and are on the right path, but unfortunately are not doing it to the degree that you should be. Now, quite frankly, journaling was one of the big changes in my journey in those early first few years. Now, I'm over 11 years in now, and journaling is still a key part of my system and my performance. I'm currently 19 months on the bounce in the green. Every trade is called live for full transparency, and journaling is a big part of that. But so many of you watching this, or those that do journal, don't journal to the extent that you should. Okay, so today's video is going to go through every pillar that you should have in your journal. Okay, every part explained, why and how we can use that same pillar to extract information that's going to help you formulate your edge, secondly maintain your edge, and third of all, that nobody ever speaks about, is to prevent edge decay. So edge decay being, you might have a strategy that's been working the last 18 months for you and you've been consistently profitable for 18 months, but how do you ensure that that edge stays true and you consistently pull profit still from the market, that healthy percentage gain? Okay, so we're going to jump into it, and I'll be sharing my screen as we do this so you can see visually, section by section, every part. So first, of course, naturally is the date, the pair, the time, and obviously long versus short. Okay, so as you can see just on the diagram there, the first one basically of your journal. Now the reason, obviously, date, naturally just want to be able to track it. It's as simple as it sounds. The pair, obviously, we want to be able to track this data, and you'll see by the end of the video how we can tie it all in together. But most importantly, time and long versus short. So the timing, eventually we're going to use the timing to see, do we find our strategy plays out better when we're taking trades in London, pre-London, post-London, back end of New York session, Asia? We need to know what time of the day we are taking these setups, okay? And also, which we'll come on to later, the time that trade finishes as well in terms of trade ranges, pip ranges. We'll come on to it all. So it's really important you're logging time and not just the day or the date it was on, because that's really useful information when it comes to tying it all together, okay? And long versus short, naturally, again, so people overlook this, but it's crazy to me because I always say to them, well, you eventually want to be able to look on this brilliant journal and go, I know on, let's use Aussie US dollar. I know on Aussie US dollar, I'm better at going long than I am going short, or my strategy performs better at going long versus short more often than not. Obviously, trading's a game of probability, so we need to lean into these probabilities. Okay, coupled with the timing, I'm better at going, say, long, but only when it's New York session, or again, and time with all the other things we're going to go through. So you can see already how it tells you more information than you realize. Okay. So secondly, as you can see just to the right of it, trade type. So is this trade you're about to take that you're journaling, is it a continuation or is it a reversal? So a continuation would be, it's already met your area of interest, it's already left, and you're simply entering into a continuation trade and scaling into that trade. So we might be bullish, it's come down to form that confirmed higher low, price has continued on, and you are basically getting a continuation trade within that leg to that next higher high. Okay, or is it a reversal? Of course, we are bullish again, we're having that natural healthy pullback, and at that higher low area of interest, whereas we're hoping it reverses, that's where you're taking your trade from. So again, if we link it with the point before, you might be better going on, going long, but on reversal setups in London or in New York. So already we're piecing together and building real trustworthy data and evidence. And we're only a couple of pillars into this video, okay? So you can see how vitally important it is. Next would be area of interest and confluences. So again, that area of interest that we're looking to take that trade from, we want to make sure it's stacked with huge amounts of confluences. Now, a lot of people suggest, well, if I have 3-4 confluences at least, it's enough to take a trade. And I say that is absolute bollocks. You should be having multiple confluences on multiple time frames that all point towards, and probability-wise point towards, a highly confluenced area of interest, okay, on a certain particular time frame. Okay, so you shouldn't have just 1, 2, 3, 4 confluences for the whole trade. You should have huge amounts to each trade. Synchronicity with the corresponding index, the time frames on the corresponding index themselves, are they in sync? There's just a few alone. There's so many things to think about. So if you find you only have 3-4 conferences per trade, there may be a potential strategy issue there. And this is why journaling is so helpful at identifying some of these problems before you spend another 6 months, 12 months, 18 months with no progression and no results. So it's about stacking as many of those conferences, writing them down in that box on your journal, and making sure so it reinforces what conferences play out time in, time again, and that typically what conferences on what time frames as well play in, time again, because they're more trustworthy, and so on and so on. Okay. Next would be risk reward and pip range. So the risk reward for me, it's always a minimum risk reward of a 1 to 3. Now that doesn't mean crazy risk rewards of 1 to 7, 1 to 8, 1 to 10. It means an average, a minimum risk reward of 1 to 3, so nothing less than that. Most trade risk rewards for me will be a 3.5% target, 3.25, 3.1, 3.89. It depends on the position, of course, but I always have a minimum of a 1 to 3. So that should always be, as it is on my journal, a minimum of 1 to 3, but we need to put the actual risk reward that it is once we've scoped that trade up. Okay. And then also pip range. And not a lot of people will put pip range on there, but I say it's vitally, crucial and important, because you might find, again, tying it in with the other points, you might find that you're better at going short on Aussie dollar, but you're better at going again at sort of New York session. And you find most of those winning trades, those optimal trades, play out over a 40, 50 pip range. But you find maybe 80, 90 pip range trades don't perform as well, or stall and don't quite hit targets, or end up being a lot more break even. You don't know that unless you put your pip range on. So it's really, really good at identifying what typical trade ranges play out for your strategy on that particular pair, with all of those other conferences and all those other points we've talked about. So pip range is massively important. Nobody uses it, nobody puts it, but it's crucially important. Next will be stop loss placement. Okay, so obviously as we're marking this trade up before we take it, so stop loss placement is obviously massive. Please do not fall into the trap of using the same nominal amount of pips per stop loss. Okay, so many people, I'm sick of seeing and sick of hearing it, because it's quite frankly wrong, and it will massively skew your profitability in the long term. Use the same amount of pips. 10 pips, 40 pips, 20 pips, 25 pips per stop loss. The same pip range for a stop loss each time. It's ridiculous. Every stop loss on each trade is unique. Your stop loss, rephrase it. Your stop loss should be, where do I need to put my stop loss? So if it does get hit, my bias, my trade, my direction, my setup is wrong, and it's truly confirmed wrong. So when you look back on your post-trade screenshots, which we'll come on to later in this video, you should find that any of your losing trades, your stop losses, should continue to go against you. Okay, so you should see that post-trade screenshot. Prices continue to go against you even after it's hit your stop loss. That's a really good sign of a great stop loss, because it's taken you out and stopped you losing more than just your desired 1% risk or whatever it was. Okay, so your stop loss placement has to be placed in a way, and it's unique to every individual trade. So many traders struggle with this. So many traders have been taught wrong, and you are leaving so much profit on the table because you're either not allowing the trade to breathe, or your stop loss is placed in a way where it's just taking you out, but it's prematurely done it. So you're taking more losses than you need to, hence skewing P&L from a monthly, from a quarterly, from a yearly performance. And that can be the big difference between being a break-even trader and being a consistently profitable trader. Stop loss placement is massive, okay? And as you can see on the diagram there, you just need to mention why you've put it there. So again, as you see good stop loss placements in your journal, it reinforces what are the habits you're doing well? What stop loss habits are you doing well? So you consistently reinforce those habits. Okay. Next will be entry price, the time frame the entry was on, and the reasoning for that entry. So again, the price itself, we need to know what time frame it's typically on, again, to refine what does your strategy perform better on in terms of entry criteria. For me, a lot of the time, I may have a 4-hour area of interest, but my entry's on the 30-minute if it's a continuation trade, okay? Because it's allowed me to scale a little bit lower to get a better entry. So it varies, okay? And you have to know this data. So you have to know what time frame that entry is on, the reasoning, of course, okay? So again, similar to the areas of interest conferences, how many, noting down, I have entered this trade because I've seen X, Y, Z, da 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 da, and it's met my entry criteria, whatever it was. But be specific, write it down. It reinforces those good habits and thinking and that systemized approach compared to entering off emotion. Okay. So make sure you've taken that. Make sure one of your pre-trade screenshots, which we're about to come on to now, your pre-trade screenshot is an entry shot, say on the 30-minute, like in the example I've just used, but also you have a pre-trade screenshot of the area of interest. So if that is on a different time frame, like I've just used in that example, so the 4-hour is where the area of interest was, then you need to take a pre-trade screenshot of that as well for context. So when you look back and reflect after the outcome of this trade, you can see that data. It's really, really important. Post-trade screenshot, what that I was just about to start mentioning. So after that post-trade screenshot, again, so if it was a loss, has price continued to run against you, which is a good thing because it's a good stop loss. Again, was it a tapped premature stop loss and then price has gone in your favor? You need to know and see that post-trade outcome. So again, the good habits that you're doing, it reinforces that. And any mistakes you're making or any refinements and tweaks you need to make, you can do because you can visually see, that's happening more often than not. That's not good. I need to work on that, tweak on that, etc. So the journal, it can tell you massive amounts of details, but it can also throw up lots of tiny details as well that are massively, massively important. And unfortunately, you don't end up knowing those tiny details unless you do this work, unless you do and have a brilliantly in-depth journal. It's as simple as that. Otherwise, you are trading blind the whole time. It's ridiculous. Okay, please start doing these things. Next is P&L, so percentage gain, the monetary value, of course. So both, was it a percentage 1% loss, was it a percentage gain of 3%, whatever it was it a break even? Also the monetary value that equated to, so that 3% may have equated to, I don't know, 18,000 or whatever, a random number, but you need to know the monetary value as well. Obviously the percentage terms as well, okay, and also the outcome of that trade. So was it a stop loss, was it a break even stop loss, was it a manual close, was it a manual partial profit, did it hit take profit? Especially with the manual stuff, you shouldn't be interfering too much or too often with your trades. It does happen, I do it, but it's got to be for a very good reason, okay? So it can be standardized and you can make sure it's positive discretion in your favor and not against you. So an example would be, let's use Aussie dollar again, and I've just seen something on the DXY on the higher timeframes that has maybe been fairly significant and has now changed the bias of the US dollar, hence why you are then manually closing your Aussie dollar trade, because it doesn't make sense anymore, or the bias has changed, or the synchronicity has changed, or the direction, whatever it may be. Okay, so that you need to document why you're interfering with it and mention the reasons, because all those reasons should be incredibly, like I've just said, they should be really good reasons, really solid reasons, more higher time frame driven reasons as well, because obviously there's so much noise on the lower time frames that can make you think about things you don't need to think about, that can make you make decisions that didn't need making. All these lower time frame traders on the 1 minute, the 5 minute, the 15 minute. So the reason if you do manually interfere has to be very, very concrete, and typically, like I said, a higher time frame reason where price or changes in price is much, much, much more trustworthy. So next will be trade duration. So a lot of people, again, won't write this down, and again, it's crucially important in terms of building your edge, refining your edge, maintaining your edge. Edge decay is the things we mentioned about earlier. So trade duration, did it last 90 minutes? Was it 2 days? Was it 5 days? Was it 18 hours? You need to know this, because again, tying into the example we used earlier, if you know you're better at going long, you know you're better at entering at this time of day where the strategy performs better with this type of risk reward, with this type of pip range and this type of duration, then you can piece that stuff together, because then when you do see a potential optimal trade but it doesn't fit into that criteria, it can be enough to go, you know what, that's not quite ready. Okay, so it's little details like this that trade duration can really help with. So it's worth putting down, okay, because it can really help you again identify, on this particular pair, I'm much better at trades that last X amount of time, that have this typical trade range, and that are typically reversal trades on these type of time frames. Can you see how we can tie it all in really, really nicely together? Okay, so really start introducing trade duration if you haven't already. Okay, Next is psychology wise, so pre and post trade screenshots, but more for this. So again, just before you're about to enter, how did you feel? Were you nervous? Did it feel effortless? Did you have that sort of homeostasis, that natural equilibrium, that good stuff? Did you feel that? Did you have that? Which is what we obviously want to optimize and achieve for. We always want to optimize in that steady, or steady, level-headed state. We don't want to be trading off emotion or entering off emotional reactivity, okay? Because that can't be consistently done over a period of time. So again, how did we feel pre-trade screenshot, and also post-trade? How did we feel in reflection, and how did we feel after the outcome? Because if you've had a loss, remember, a losing trade should look exactly the same as a winning trade. They're both optimal. So ideally, as you find that you're getting better and stronger up here and being a better decision maker and executor of your strategy, you should find after each trade you go, yep, happy with that. I'd take that again in a heartbeat. Perfectly optimal, met all my criteria, met all my rules, position sized accordingly. It was all there. I would take that trade 100, 500, 1,000 times again. That's how every post-trade psychology sort of note or comment should look eventually, okay? Which really proves to yourself you're getting somewhere, both technically, but also most importantly, this, okay? With that consistency and discipline. And last but not least, optimal. Is it optimal? Was it optimal? So I've already kind of beaten you to it on that last comment, but would you take this trade again is the simple question in this category. If the answer is yes, brilliant. If the answer is no, you need to then go back, as you should be anyway, reflecting on every single trade. What should you have done? What did you overlook? What did you miss? Whether you deliberately overlooked it because you forced a position, or whether you genuinely just didn't realize or notice it or pick up on it. And that's why journaling is brilliant, because it really helps, as I mentioned earlier, really iron out any nooks and crannies, any little details. It's really good at refining an edge, because a lot of people think they have an edge and a strategy, but actually they are going in blind still. It might work for 6 months. It might get them a couple of payouts, but a couple of payouts is nothing. We want longevity. We are playing the infinite game with trading. We want it to pay us for life, not just 6 months worth or 3 months worth, because you'll never make it your full-time income, because you'll just massively peak and trough. So journaling is super, super helpful. It is one of the big turning points in my journey as well. So please, if you're not journaling, then shame on you. You need to, if you want to take this seriously. And if you are journaling and you haven't got any of these points in there, start bringing them in. It's really helpful, and I promise it will only help, and it will only help you get better as a trader. And that is ultimately what I care about, is that you get to where you want to get to in trading. So guys, as always, thank you so much for watching. I really enjoy making these. I really, really do. If you need any help, reach out. And if you want me to send you this sort of journal sort of overview, then drop me a comment below with your email, or drop me an Instagram DM and I can send it over. Guys, thank you as always, and have a great rest of the day.